Your Royal Highness, ladies and gentlemen, it's a pleasure to be asked to speak to you today about a subject which has grown in focus for our funds over the last 15 years. From initial paper from a single trustee who felt passionately about ethical investment to working through how to incorporate socially responsible themes whilst meeting the fiduciary requirements to invest in the best interests of the beneficiaries, which we believed was possible in 2000. And implementing the first part of the programme with a simple checklist of questions to all the UK companies who came through the door. The trustees have embraced the benefits of incorporating these values within traditional analysis, where we can. We can't do it in every company in every country, but we believe that it provides a better picture of the long-term sustainability of a company. And just to put some of my comments in context, a few words about how we manage the BA schemes, which I believe has provided us with opportunities for closer engagement with the companies that we invest in. The schemes have always maintained a relatively high level of internal management of assets and a team of active fund managers rather than passively following an index. This leaves us relatively well resourced compared to some others. This has allowed the team to be much more involved in engagement programmes over the long term. And I think a key point is that both the team and the assets that they manage have had substantially lower turnover than is typical for the industry average. And that's an outcome, it's not a target, but it's been true over the long term. And this will also assist in engagement. Many of the improvements in environmental and social attitudes evolve slowly over time in an incremental fashion rather than a step change. And so to have a worthwhile and healthy dialogue with companies on issues which can be subjective in the short term, very different to the normal numbers and facts of investment analysis, it requires the fund managers to have a good understanding of the impacts of a company and an understanding that short-term performance is not everything. The support provided by corporate governance and responsibility specialists within the group who can apply peer group context is invaluable as well. And a longer-term perspective has been required to appreciate the gains made so far and to measure successes and failures. Otherwise, there is a risk of discounting the process as marginal. In preparing these comments, we looked back at the first reports we prepared on the subject in '98 and the information available for peer group comparison. And it was instructive and pleasing to see how corporate participation and information has developed since the early business in the community reports, which had already moved on starting in '95 and by '98 had moved on significantly. And these reports we use as our basis for measurement provided good evidence to silence those sceptical of the benefits accrued over the intervening years. And for those who have yet to start incorporating SRI values into the investment process, I would stress that you can start with one theme or one project, maybe as part of a collaborative effort rather than having to cover every single stock in the portfolio. And this can still have valuable benefits as you build up a picture of a company and its culture over time. We consider it important that pension funds consider environmental and social risks because given our long-term liabilities, the trustees, sponsor and beneficiaries are exposed to the risks or opportunities from changes in the environment or society over a long horizon. Climate, demographics and social change have an impact on real interest rates, which directly affects the funds. Whilst we use models and history to assess many of the other risks, such as interest rates, inflation and market risks, just because it can be difficult to understand the pros and cons of any environmental development and social change, it does not mean that they should be ignored. The burden will fall on society at large, but as with other investment risks and rewards, we do not know which generation will bear the burden. As much as possible, we wish to invest the assets to be insulated from the negative effects and to be positioned to benefit from the positive changes, so the research and time taken can be positive for the fund as well. We're long-term providers of capital, and we're well placed to invest in technologies or projects developed to deal with environmental and social change. So we also have to be ready to evaluate these to ensure we can participate where appropriate. I was asked to comment on the practical aspects of how a pension fund can manage these risks and how it can be incorporated into fund managers' mandates, and so I'll talk about some of the challenges that remain. I think the challenge, as I said earlier, was where to start. We had to start alongside a corporate governance programme that had been running since the early 90s and had a lot of history. But there was a growing body of evidence there to suggest that better corporate governance improved return for stakeholders, not so with SRI. By the end of the 90s, we wished to have an equivalent process and started off with ad hoc projects and a simple checklists I discussed with companies who came through the door. And year by year, we participated in more industry debates and shared ideas with others. As I've already commented, the ongoing development of the Business in the Community Corporate Responsibility Surveys, FTSE for Good, and latterly initiatives such as the Carbon Disclosure Project, amongst many others, have greatly assisted the fund managers in collecting the information and helping to give them tools to facilitate the dialogue with the companies, analyse and then make decisions, sometimes very difficult conversations compared to the normal conversations they have about hard numbers. Gradually, information is improving outside of the UK, an increasing number of credible shareholder actions in North America, and initiatives in Brazil and South Africa that are empowering shareholders by giving them better information. However, many regions have some way to go to match the UK, and it is a challenge to standardise the approach between the different fund managers. Elsewhere, in the last few years, we've extended our monitoring to alternative assets, the private equity portfolio, and the property assets. As I discussed, our organisation has had the luxury of long-term support from our trustees to develop a programme over time where we can cite lots of anecdotal examples of the benefits and demonstrate incremental improvements through an annual reporting and review process, which we share with the membership. And the membership do regularly send in emails asking us questions. There is a commercial rationale for trustees, as lower turnover from greater long-term thinking reduces costs. In addition, markets do not like negative surprises, nor do the trustees and the beneficiaries. Poor outcomes in respect of environmental and social change will negatively impact valuations of investments or increase their volatility, which is also unwelcome. In general, there remains a challenge in measuring the effectiveness of a long horizon initiative with large elements of subjective judgment in the short term and ensuring the alignment of interests. As you're aware, the asset management industry measures performance on a short-term basis in basis points, and risk is measured as the variability of performance from a benchmark. And this is compounded by the reward structures in the corporate world, which are also short-term in nature. Current incentive arrangements are impediments to long-term thinking, and more work needs to be done in this area. We have travelled a long way since the early initiatives nearly 20 years ago, and the growing body of evidence will help support others in future positive developments. As earlier mentioned, investment consultants say you need an 18-year-plus track record to demonstrate skill in active management. There is now enough information to start measuring the impact of SRI. The incorporation of such issues and longer-term planning into investment strategy is important to portfolio management now and in the future. We are in an era of low real yields and, as discussed earlier, high costs through greater turnover and the volatility of negative surprises eat into already low returns. Where demographics already suggest a greater burden on the working population in many developed countries, the ability to reduce those costs and be aware of opportunities from environmental and social change will optimise the returns for our beneficiaries. Thank you, ladies and gentlemen.